2021 has been another good year for stocks. Apart from the last 2 months, we were still in pretty good bull markets. As of the 17th of December 2021, the S&P 500 is up 24.7% year to date, which is pretty high. On average, an investor expects around 7% annually returns, so this is more than 3 times that. While everyone is happy with their investments, things haven't been really going well for me in terms of my investments this year. I don't know my exact returns because I changed brokers a few times throughout the year, but I do know that it is definitely underperforming the S&P 500 and by quite a bit. Investing this year taught me many things, I would say a lot more than 2020, so I will be sharing the 5 biggest lessons that I learned investing in 2021. Let's get started. Cha-ching! So the first harsh lesson that I learned is that everyone is a genius in a bull market. 2020 was a special year. Despite everything that went on, stock markets still rallied and many stocks went up more than 100%. Even though I started investing in 2019, 2020 was the year that I really started to put more money in it and be more involved in investing in individual stocks. I know that many of you can relate to this as well because 2020 was also the year that saw the highest number of new brokerage accounts opened by individuals. A lot of people, including myself, started investing in 2020 and it was a very easy journey, making us all think that we're geniuses. If you started in March 2020 especially, it was super easy. Just pick any stock and you'd probably be up for the year. It was really a case of a rising tide lifting all boats. Because of this, I got a bit too confident and I thought that investing was just too easy. Every stock that I bought went up. If there was a dip, I would just buy more, right? Just buy the dip. And in no time, those positions would be up as well. The thing is, all of this changed in March 2021. Countries were starting to reopen, economies were starting to recover, and because of this, the Fed started printing less and less money to boost the economy. There were early signs that a lot of the stocks that I owned or the leaders of 2020 were starting to sort of break down and drop in price. But because I thought I was a genius, I just continued on in my ways and I thought that anyone who was being cautious is silly and just didn't get my investing style. So the good thing from all of this is that at one point, many of my stocks was up over 100%, meaning my portfolio returns were amazing. The bad thing is, when the tide started to shift, I wasn't ready, I was being lazy, and a lot of stocks that I owned actually gave back a lot of the gains that I made over the last 1 year. So the lesson from all of this is that because many of us started in 2020, it was very easy and a lot of stocks were just going up where the market really lifted every single company. 2021 has been a harsh reality check for me, so I need to really double down and focus when I want to invest my hard-earned money. The second thing that I learned can be quite contradictory to what many people learn from personal finance and investing. It is that the popular saying, just buy and hold, doesn't really work, especially if you invest in individual stocks. This is further amplified by a study done in 2013 where Fidelity showed that the people who made the best returns on their portfolios are the ones who are already dead. They explained that because these people are dead, they literally buy and hold, never make any trades, and because of that, they outperform all of those people who make buy and sell trades throughout the years. Well, the thing is, markets have gone up, yes, but individual stocks can lag for a very long time and some stocks may never revisit their all-time highs ever again. During the dot-com bubble in 2000, many tech companies took a beating and their share prices dropped more than 80%. Even Microsoft, which is a very solid company, saw their stock price tumble. So if you thought, I bought Microsoft stock at the top of 2000, who cares? I'm up a lot right now, right? Well, the thing is, the share price never reached its all-time high set in 2000 for 15 years. I don't know about you guys, but I don't want to be holding a position in the red for that long. And this is a story of a company that actually made it through and managed to turn around their fortunes. For every Microsoft, there are tens or hundreds of other companies that never made it out or are still way below their all-time highs. So in this case, buy and hold wouldn't really work. And I see the same thing panning out in 2021. Many of the stocks that had very good returns last year are starting to slow down a bit, and if we just took the approach of, hold these investments, I don't care, they will go up in the long run, I think that we can take a beating on our portfolios. Yes, some of them are actually solid companies, they have good projections, and we can possibly make good returns in the future, but we can't just turn a blind eye. We still need to take a look at things like earnings reports, make sure the company is still on track. And if execution is starting to get weak, let's say revenue growth or profit growth is slowing down, then we really need to reconsider our position in this company. Many of the stocks that I owned from last year who were up 100, 200% went through this phase earlier this year, but I was stubborn because I was stuck with that buy and hold strategy, and despite having poor earnings reports, I never sold. Going into next year and moving forward for me, for individual stocks especially, it's not going to be buy and hold, it's going to be buy, hold and monitor, and as soon as these companies start to show weakness, I will be out. By the way, if you guys want to buy stocks, especially in the US or foreign markets, then sign up for Interactive Brokers. We'll leave the link down in the description below. Let's move on to the third lesson I learned, which is that valuations don't matter until they do. Many of the stocks that I owned saw their valuations balloon, and that is why I had very high returns in the first place anyway. A lot of these companies had a price to sales ratio of 50, meaning that if they had $1 million in revenue this year, they were valued at $50 million. Before the bull market in 2020, these companies were only trading at around the 10 price to sales ratio, but because of more liquidity and a lot of investors putting more money in the market, their valuations really started to skyrocket. I actually saw some people on Twitter doing analysis on these stocks and just showing that because their valuations are way too high, even if the company does well or meets expectations over the next 5-10 years, an investor can expect to make minimal returns because the price has already shot up. I also saw other people who said that valuations are the new normal, expensive stocks are expensive for a reason, you're paying up for high quality. Well, that is true, but there's a certain limit to that. Well, now these stocks are starting to take a tumble. You can only maintain 100% revenue growth year over year for so long, and eventually you'll start to taper down. Show me a company who's going to double the revenue every single year for the next 10 years, and I'll put all my money there. You can see this example in many stocks that I used to own, like Zoom, Mercado Libre, and Teladoc. Some of these companies still have very high valuations like Shopify, which I expect the price to drop down soon. And y'all may kill me for this, but I have to say it, another example of a company with bubble-like valuations is Tesla. It is an awesome company, I love what they're doing, I love Elon Musk, but at this point, the valuations are just way too high and it's a bit unrealistic. To me, there are only two outcomes for this. First is that Tesla is going to beat everyone's expectations and the stock will actually generate good returns for investors. The other scenario, which I think is more likely to happen, is that Tesla's share prices will either drop or it will trade sideways for the next few years, waiting for valuations to catch up. The lesson from all of this is that when we own a stock and the valuations start to get very high, we've made a lot of very good returns, it comes to a point that you may think that, it's time to take profits because this is just not sustainable. Next up, this one was a painful lesson and it was so obvious. Well, the thing is, I realized that I invested in stocks based on their share price instead of the actual fundamentals. See, the thing about long-term investing is that we buy the very best companies that we believe will have a very good future and resultingly grow their revenues, their profits, and give us good returns. I thought I was doing that, but reflecting back, I realized that whenever I saw a stock start to go up in price steadily, I would just buy it first and then find out fundamental stories to sort of fit my narrative and persuade me why this company is good. As soon as the stock saw a correction though, so maybe it dropped 20%, I started to question myself and think, maybe the fundamental story is not that good after all. Well then, if it bounced and went back up again, suddenly all those questions are gone and I don't even care anymore. So it was very obvious that I was making buy and sell decisions based on the price instead of the fundamentals, and that is not long-term investing. There is another name for that, and that is trading. So there's no problem with trading. In fact, I posted a video a few months ago talking about how I'm splitting my portfolios into an investment one and a trading one. This way I can be more focused, I can get better profits, and I don't have to lie to myself about why I'm buying a stock. Now, in my trading portfolio, if I buy a stock, I know it's not purely about fundamentals, I'm also buying because of price, and if price starts to weaken down, I will sell. This is something that is very difficult for many investors to overcome. even the very best ones. You know, you can say you have extremely strong conviction in a company like Tesla and you know that they will grow profits in the future. However, if the stock, declines 50% over 2 years, how strong can your conviction really be? At the end of the day, it's our hard-earned money after all. We actually worked, saved up to put it here, and it's very difficult for us to separate emotions from investing when our money is involved. So the lesson here is to be real with myself. If I want to invest my money, then leave it there. Ignore short-term price movements, just focus on the fundamentals. And if I want to trade, then be very clear on that and just focus on that so that I'm not mixed between the two and then not maximizing my profits. So take this and reflect it on yourself as well and your investments. Are you buying because the stocks are going up or because you really like the company? And all of this leads me to my final realization that most investors should go through passive investing through assets like ETFs or mutual funds. Even better yet, with the introduction of robo-advisors like StashAway, Wire Invest, you can get an even more diversified portfolio including multiple ETFs and bonds, and you won't have to think so much about which one to buy. Earlier this year, I was thinking that I would never need to invest in an ETF ever again. Warren Buffett telling everyone to invest in the S&P 500. He's just an old guy who doesn't understand things because my individual stock portfolio has been performing so well. After going through the previous 4 lessons that I was talking about, I realized that it's not that simple and I've moved more than half of my total investment portfolio into ETFs. And this is talking about me. Look, I go through charts every single day. I actually track companies, read through their earnings reports and see how they're doing. I know many of you don't do that or you don't enjoy that, and that is completely fine. However, what I'm saying that is even despite me putting in all this time, I already put half of my portfolio in the ETFs because those things just perform well. If I did that, my 2021 returns would have been much better after all. If you want to sign up for StashAway or Wire Invest, you can find our links or our codes down in the description below as well, and you can get some nice goodies from them. So to put things in a nutshell, investing is hard, but we can still make it easy. Of course, I'm not saying that you guys should invest. I still think every single person should invest if they have the money. But if you want to invest in individual stocks, then I really recommend that you reflect on the things that I mentioned in this video so that you don't have to go through these painful lessons like I did. Despite saying all of that and going through it in 2021, having low returns, I will still continue investing in individual stocks because I enjoy it, and I think, or maybe I hope, that in the future I can get the hang of this and really start getting better returns than ETFs. Still, I will have a big portion of my investments into ETFs because those things, they're just compounding machines. I don't have to think and I just let it run on autopilot. For most of you though, stick to ETFs, stick to robo-advisors. You will thank me. If you guys want to start investing, there are many different ways. Individual stocks, there's interactive brokers, there's Rakuten, and for robo-advisors, there's Wahid and StashAway. If you want to sign up, use our links. We'll leave it down in the description below. And thank you guys so much for watching this video to the end. Give us a huge thumbs up and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.